In one night, without warning, the rules of American banking were rewritten. No debate, no headlines, no chance to prepare. While the country was distracted, a hidden signature triggered the most aggressive financial shift in decades, and it will pull crypto in the heart of every U.S. bank before you can blink. You won't see this on the nightly recap. There's no ticker for structural change. But from this point forward, the rails beneath your paycheck, your savings, and your bank's balance sheet will not look the same. The shift isn't coming. It already started. On August 7, 2025, a new executive order was quietly signed. No fanfare, no emergency press conference, just one line in the Federal Register, and the fuse was lit. But to understand what this really means, you need to go back, because this wasn't the first move. It was the final one in a strategy that's been building for months. Back in January, Executive Order 14178 redefined the U.S. position on digital assets. It banned the Federal Reserve from issuing a central bank digital currency. But at the same time, it established something far more consequential, a strategic Bitcoin reserve, backed by U.S. taxpayer funds. That moment didn't just make crypto a national asset, it made it a matter of national security. Then came March. Another executive order dropped. This time, the White House created a presidential working group on digital asset markets, giving the administration sweeping influence over how crypto integrates into public and private financial infrastructure. And now, in August, the final domino has fallen. This order didn't just greenlight crypto for retirement accounts, it weaponized regulation to make it happen. 401ks, IRAs, pensions, all now have a federally backed lane to flow capital directly into digital assets. It's not a suggestion. It's a structural override. The average American still believes crypto is a fringe experiment. But when you peel back the headlines, the architecture is already being poured. This isn't just about wealth preservation. It's about wealth positioning in a system that is actively being rewritten behind closed doors. In plain English, it legalizes and prioritizes the placement of digital assets directly into American savings accounts. But that wasn't even the most important part, because in the very same order, another directive was buried beneath the headlines, a full-scale crackdown on debanking. The phrase reputational risk used to be a catch-all for quietly cutting off crypto firms. Now that shield is gone, and banks are under direct threat if they use it as an excuse. This is no longer a gray area. It's black and white and punishable. If a bank refuses to serve a digital asset firm, payment rail, or blockchain platform without documented non-political cause, they're now in direct violation of federal executive authority, which means the rules of the game have just changed. And the new playbook doesn't favor traditional finance. There's a reason this happened in silence, because if it had been shouted from the rooftops, it would have caused chaos across Wall Street. Think about what's at stake. Every major bank, from JP Morgan to Wells Fargo, is now facing a two-sided squeeze. On one end, they're legally required to integrate crypto access for consumers. On the other, they're barred from denying services to crypto firms. In a matter of weeks, this has flipped from crypto being risky for banks to banks being at risk for not offering crypto. And what most people don't realize is that these changes are legally binding, not optional. Regulators are no longer debating whether crypto belongs in the system. They've already carved out the space. The banks are being pulled into it, whether they're ready or not. That's the reverse of no one's talking about. And it's already being felt behind the scenes. Early reports indicate several mid-tier banks have been quietly rolling out digital asset custody services in response. Major brokerages are expanding access to tokenized products, and fintech providers are scrambling to realign their offerings to match the new federal mandate. But it goes even deeper, because buried in the details of the order is a clause calling for interagency cooperation to ensure the development of alternative asset access pathways across traditional banking infrastructure. Once these systems are fully live, the opportunity to act early disappears. The biggest gains are never made in the spotlight. They're made in the silence right before the rest of the world realizes what's happening. And you're in that moment now. Translation? Federal regulators aren't just observing from a distance. They're entering boardrooms, rewriting protocols, and engineering partnerships behind the curtain. This is executive order crypto integration. No bank can opt out. This isn't about offering crypto as a niche product anymore. It's about weaving it into the core plumbing of the financial system, from retirement plans and savings accounts to payment processing and capital allocation. And here's the part that should really make you pause. There's no opt-out. Whether you're ready or not, the rails are being laid. The train is coming. Look deeper into the language of these orders and you'll see something chilling. Words like enforcement action, mandate, and cooperation requirements aren't suggestions. They are signals. Signals that the era of voluntary crypto adoption is ending, and the era of forced integration has begun. Here's why that matters. For the last decade, the crypto market was treated like a rogue sector, a speculative playground, a regulatory nightmare, something to be kept at arm's length. But now, the highest office in the United States is actively embedding it into the foundation of retirement finance, institutional banking, and long-term national strategy. That shift is not just symbolic, it's systemic. It means the rules of wealth building in America are being rewritten in real time, and the average person is still playing by the old ones. Ask yourself, if crypto is now protected, backed, and integrated by executive order, what happens when it goes from being an alternative asset to an obligatory one? We're entering a phase where the illusion of financial choice may evaporate entirely. Just like how cash slowly disappeared from everyday use without anyone voting on it, digital assets are being embedded into the rails of everything, from payroll processors to pension funds. And it's all happening faster than most people can track, because that's where this is heading. Once it's embedded in 401ks, once it's required for banks to offer it, once interagency cooperation links every piece of the puzzle, it stops being optional. And when that moment hits, you don't want to be caught reacting. You want to be positioned. This isn't just a financial update. It's a structural one, a silent reordering of the entire U.S. wealth architecture, driven not by the free market, but by the highest levels of executive authority. And the question isn't if crypto will become part of your financial life. The question is, will you be a participant or a bystander? Because when history looks back, they won't talk about the headlines. They'll talk about what happened in the shadows. If you're still watching, you're the kind of person this channel was built for. No hype, no distractions, just real-time decoding of the biggest financial shifts in the world. So if you're ready to stay 10 steps ahead, subscribe to Wealth Signal and make sure you're not the last to know what's coming. They didn't ask. They didn't signal. They just moved. And while the usual gatekeepers kept everyone focused on noise, the blueprint for a new banking reality was slid into place. If you miss this shift, the system won't wait for you.